Welcome to the Deep Dive. Today, we're really tearing into the American Express Q3 2025 earnings call. Now, if you listen to the transcript, you know the numbers look good, strong even, but the real story, I think, is the confidence behind their strategy. They're betting pretty big short-term investment for, well, long-term premium loyalty.
That's absolutely right. Yeah, our mission today is really to get past those media headlines. We want to focus on, let's say, three key things. First, understanding the huge momentum from that new Platinum card refresh, then really dissecting the health and spending habits of their premium customers in what they keep calling this bifurcated economy. And finally, sort of cracking the code on their accounting, specifically that 2-year lag affecting when today's big investments actually turn into profit.
Okay, let's start with the results then, because they really set the scene. American Express had a record quarter, just blew past expectations. Revenue soared 11% year over year, climbing up to a hefty $18.4 billion.
And you saw that leverage hit the bottom line, too. Earnings per share, EPS, was up, I think, a blistering 19% to $4.14. Look, a beat is always good, but the real signal, the confidence signal isn't just the quarter. It's how they adjust the forecast.
Exactly. And they were confident enough to actually raise their full-year guidance pretty significantly. They're now projecting full-year revenue growth between 9% and 10%. And they tightened up the EPS target range, too, aiming for $15 to $15.50. This isn't just about finishing the year well, it's signaling momentum carrying into 2026.
Yeah, and if you're looking for what's fueling that confidence, that guidance raise, it's unequivocally the recent Platinum card refresh. U.S. consumer and business both. Management used some pretty strong language. They call the launch the strongest start they've ever seen for a U.S. Platinum initiative.
That's a huge claim, right? For a company that constantly tweaks and enhances things, what metrics are they actually pointing to? What backs that up?
Well, the acquisition numbers are, frankly, staggering. New Platinum accounts are being opened at double twice the rate they saw just before this refresh launched. So this isn't just, a little bump. It's a step change driven by that enhanced value.
Okay, but acquiring lots of people is one thing. Are they getting the right people? Is this diluting their credit quality at all?
That's the critical point here, isn't it? They specifically reported that the credit profiles of the new consumer applicants post-refresh are actually stronger than the already strong base they had before. The average FICO score for these new applicants, up 15 points. So it suggests that the higher fee and the premium benefits are acting as an even better filter. They're really capturing that top tier of creditworthy folks who value the Amex ecosystem.
Okay, that definitely lowers their risk. What about engagement, though? Are people just signing up, grabbing the bonus, and then sticking the card in a drawer?
Doesn't seem like it. Far from it, actually. The engagement signals flashed pretty much immediately. They mentioned that in just the first 3 weeks, they got over 500,000 requests for that new mirror card design. Now, you could say that's just vanity, but I think it shows people were quickly putting the card in their wallet, using it, wanting to, show it off.
Okay, here's where it gets a bit tricky and where, you listening really need to understand the accounting mechanism. This huge investment in benefits and acquiring customers leads straight to what they call the J curve, the investment trade-off.
Right. This is really the core of the investment thesis, I think. Management was explicit. They're doing this with their eyes wide open. They know it creates short-term financial pressure.
Okay, let's break down that pressure, because it's about timing, right? Accounting timing. What's the immediate shit they're willing to take?
The hit comes from the difference between when they book expenses versus when they book revenue. So when Amex offers these great new benefits like those quarterly credits with partners, the value of those benefits, what they call variable card expenses or VCE, has to be expensed immediately, right when they offer it. So you get this instant hit to the VCE to revenue ratio. Puts pressure on margins right now.
So costs booked up front, but the revenue from the higher fees is delayed. How long is that delay and why?
It's a significant delay. The fee revenue isn't booked instantly. They amortize it, spread it out over the full 12 months after a customer's renewal date. And because a lot of existing customers get the new benefits before their annual fee actually goes up, and then that increase gets spread over a year, management says it takes roughly 2 years, 24 months. For the full positive impact of the fee hike to show up in the numbers, they expect the peak contribution to growth about 12 months after the new higher fee actually starts for that customer.
Wait, 24 months? That feels like kicking the can quite a way down the road, and it adds some real risk, doesn't it? Let's be critical for a second. If they're loading up all these costs now, what if the economy tanks next year? Or a competitor launches something amazing? Isn't this whole strategy basically banking on a stable, long-term outlook for their specific high-end customer.
It absolutely is. It relies on two things: the stability of that premium customer base and the stickiness of their whole ecosystem. They're essentially betting that the value they're pouring in now guarantees renewal 2 years from now, almost regardless of wider economic bumps. It's a massive long-term capital allocation choice. They're sacrificing some near-term margin for what they hope is sustainable, sticky growth that supports that ambitious goal of mid-teens EPS growth. If you buy into the idea that the high-end consumer is insulated, well, this accounting lag is where the potential alpha comes from.
Right, which makes customer spending and keeping those customers even more critical. Okay, shifting gears a bit. New acquisitions aside, what are the actual transaction numbers telling us about how their current premium customers are doing?
The spending acceleration is pretty telling, actually. Total billings were up 8.5% FX adjusted, so taking out currency effects. That's actually a noticeable step up, about 2 percentage points faster than Q2. It suggests customers aren't just holding the card, they're actively using it more.
And we can see where the money's going. Retail spending looked solid, up 12%, but the return of travel and entertainment, T&E, that's always the big story for Amex, right?
Absolutely. And T&E is really firing on all cylinders. Restaurant spending, which is their biggest T&E category, grew 9%. But the really illuminating metric, I think, is the premium T&E segment. Spending on front-of-cabin airline tickets, first in business class, the real indicator of high-net-worth travel, goes up a very strong 14%. Their core customers aren't sweating the budget airline prices. They're focused on premium experiences.
And this connects directly to that demographic shift they talked about. Millennials and Gen Z now make up 36% of total spend. That matches the share of Gen X now. This isn't just about getting younger customers. It's about making them the future loyalty base.
That's the strategic goldmine right there. And let's pause on the engagement for this younger group. The average number of transactions per U.S. customer for millennials and Gen Z, it's about 25% higher than for older cohorts. Why is that significant?
Well, that 25% difference suggests a huge behavioral shift. Older groups might use AmEx for big ticket items, flights, luxury goods. That higher transaction count suggests millennials and Gen Z are treating it more like an everyday spending tool, integrating it into daily digital life, lots of smaller transactions.
Exactly. It feeds that virtuous cycle perfectly. Get these engaged customers early, weave the card into their daily habits via digital use and high frequency, and then you amortize that acquisition cost over potentially decades of loyalty.
Okay, and on the macro picture, are they seeing any of that consumer stress we keep hearing about in the headlines?
Their answer was pretty definitive. No. Credit performance is still excellent and stable. Delinquency rates, write-off rates, they're still comfortably below pre-pandemic 2019 levels. Management really hammered this point about the bifurcated economy. Their premium card base is highly creditworthy, fundamentally insulated from the broader weakness. They even specifically said they saw no material impact from all that noise around the government shutdown.
All right, let's look under the hood a bit at the financial plumbing, how the revenue stream is built. Net card fees are getting close to $10 billion a year now. That's 29 straight quarters of double-digit growth. That reliability is huge. Net interest income, NII, the revenue from lending also strong, up 12%.
Yeah, and there was one bit of sort of technical housekeeping they pointed out. Investors need to be aware of it. It was in the service fees and other revenue line. There was an $80 million gain in there related to a merger transaction at the Global Business Travel Group. That gain added about 5 percentage points to the growth of that specific line for the quarter.
Okay, so if you mentally adjust for that one-time gain, the underlying growth was still really solid, double digits. Proof the organic momentum is there. Now, how are they managing those big investments we discussed earlier? Are they being disciplined?
It seems highly surgical. The marketing spend is really laser-focused on welcome offers for fee-paying premium products. They noted 70% of new accounts they got this quarter were fee-paying cards. And apparently, every marketing dollar is run through strict profitability checks, rigorous ROI measurement. They want to ensure those higher investment levels are building long-term profitable relationships, not just chasing empty numbers.
Which confirms their whole strategic outlook, right? It's still centered on hitting that 10% plus revenue growth, mid-teens EPS growth long term, underpinned by constantly improving the product, strengthening that loyalty cycle, and growing merchant acceptance, which is up almost 5 times since 2017, remarkably.
Yeah, the key takeaway for an investor looking closely is that the core profit engine's true strength is deliberately being masked a bit by that accounting timing. They're actively investing now for revenue and EPS growth that won't fully show up and get celebrated until fiscal 2026, maybe even 2027.
Okay, now for our final segment. This is not financial advice. We like to wrap these deep dives with a, let's say, high conviction, maybe slightly outrageous, but plausible trade idea based on the analysis we just did.
Okay, so the core idea for this trade hinges on the market underestimating the platinum refresh's impact because of that accounting lag we talked about.
Yeah.
The immediate VCE expense hiding the deferred revenue buildup.
Right. So we're betting against a short-term accounting view and betting on management's long-term execution. What's the trade structure?
The play is about using time and divergence to your advantage. You could consider going long AXP call options dated maybe 18 to 24 months out. Specifically, maybe target mid-2027 expiration. That's when the peak impact of the new fee revenue should be hitting the P&L, and that mid-teens EPS target should be getting clearly validated by the actual results.
Okay, so that plays the long cycle of their premium strategy, assuming their core customers remain pretty resilient macro-wise.
Right. And to maybe add a bit more asymmetry or hedge against general market doubt, you could think about pairing it. Simultaneously initiate a long-short pair trade, short a non-premium credit card issuer, one whose business is really exposed to the lower-end consumer, whose write-offs might normalize higher. This directly plays Amex's own commentary about their insulated premium base versus the broader consumer credit market. You're basically trading the bifurcated economy thesis itself.
That's a powerful way to synthesize it. Okay, so to recap our deep dive, American Express is pushing hard on its premium strategy. They're doubling down on platinum to capture these really engaged high-end consumers. And it's already showing up in spending, accelerating, and those, frankly, exceptional acquisition numbers.
Yeah, the confidence seems warranted. You've got the raised guidance, strong execution on spending, and this strategic choice to invest heavily upfront for that sustainable long-term growth. It really confirms their leadership in premium finance and just highlights why you have to look past the single quarter numbers of these guys.
And as we wrap up, here's something to think about. Management mentioned they regularly talk about potential product tiers between Platinum and the ultra-exclusive Centurion card. So given how much they've packed into the new Platinum, what kind of extra benefits, perks, or exclusivity would even justify a tier above that, but below Centurion? And who exactly is the target market for that kind of ultra-premium gap product? That's the question we'll leave you with today.